Hey, good afternoon, everyone. This is Mark from Right Line Trading. I really appreciate you giving me your time. I'm going to really show you two amazing indicators that in combination are really, really going to, I believe, help your trading immensely. And I just really want to read the mandatory disclaimer, and then I'm going to go over to the charts. All signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers in the futures or forex or stocks for any profits or losses that may be incurred. Participation in trading the forex, futures, and stock markets involves substantial risk and should be understood that a person can lose a substantial amount of money. Therefore, the participation in these markets is not appropriate for everybody. Do your own due diligence, consult a financial advisor prior to making any trading decisions. And those of us at Right Line are not registered financial advisors and not licensed commodity trading advisors. And with that, let me drop the slides and go to the charts. And the first thing I want to do is to talk to you about volume. Now, what I did was I put up it's a 1 minute chart. Let me just change the properties here because it's got some of my entries from today. I don't know how I can do that, but that's okay. If you'll notice, this is a standard volume analysis. And what this volume analysis does is, if you hang on for 1 sec, I'm sorry about this. Hold on 1 second. Okay. Here we go. Let me open this up. Now, this is a range chart. And this is an 8 range, and it's crude oil, but it doesn't really make any difference what the instrument is. And underneath is simply volume. Total volume that accumulates underneath each candle. Now, I've seen lots of webinars, lots of software, lots of traders talk about volume using this standard indicator. And there's a big problem with it, and there's a big problem with the way that we actually think about volume. Now, I'm not talking about volume profile, which is different, but leveraging total volume, or the number of contracts that are crossing at any given time. And it could be contracts, it could be lots, it could be shares. It doesn't make any difference what the financial instrument is. It's simply associated with some amount of volume per unit time. And when you see volume spikes like this, retrospectively, I see lots of webinars where an analysis is done associating, associating this spike with this candle. And we know that this is how much volume accumulated under this candle. Here's the problem with this analysis and why this entire way of looking at volume really is totally ineffective. And if anything, it actually is more confusing and obfuscates things a lot more than it clarifies what's going on during the trade. And that is because during this time period, during this candle, you don't know how long this candle took to form. If you're trading Unirenko, you're trading Renko, you're trading range. Um, if the power of the bulls equals the power of the bears, this candle could take 3, 4, or 5 minutes to form and complete. So you're simply going to get volume accumulation under a candle that doesn't move because you've got that fight going on inside the candle. This volume spike is not necessarily associated with an increase in overall volume or volume rate at this particular point in the market. So doing this kind of analysis is just really totally useless. And doing any kind of look back to try to say that, that this is right here. Climactic volume associated with a fall in price is really very misleading, because again, we don't know the period of time it took for this candle to form. And when time is a component and part of the candle, this kind of analysis simply does not work. So what I want to do is show you what we've created and how we've gotten around that. So just let me bring up my slides. Now here again, I talk about the volume assessment. I didn't realize that had a slide that presented it. And I told you about the caveats and why it's very misleading. And in real-time trading does nothing to help you determine whether or not to enter a trade or stand down on a trade. Doesn't call a top or a bottom. It does nothing to help you in terms of trading. So what we did, here's just another example. This is standard indicator. It's looking at buying volume and selling volume, which is in the majority. And obviously, if a candle is down, you've got more selling pressure than you have buying pressure. But again, it provides you with no information regarding how price is going to move off the right edge of the chart. And that is the key to what we need. So what we did was we created what's called the volume hammer. Now the volume hammer is an indicator that looks at the number of contracts or the number of shares or the number of lots traded per unit time. Now I have this set at the number of contracts or lots or shares traded per minute of time. Now, this kind of snapshot has to be taken in real time, because these candles are moving at one speed, and the volume hammer is creating a new line every minute. And this was all done as real-time snapshots. And you can see how when you actually have an accurate analysis of the amount of volume crossing, and you get a volume spike underneath a candle, it actually acts as the fuel that is going to push a trade in a direction. And it's almost always going to move in the direction of the trend. This is a 50-period SMA. This is a 15-period SMA. And you can see when the spike occurred. Price moved laterally and consolidated. It hit support. Volume spiked. It broke out of consolidation and moved to the upside. This, in real time, is a tool that you can use to predict the break out of consolidation or simply a move up in price when you get this spike in volume that is constantly making an assessment every minute. And in real time, you can see this line moving up, moving up, moving up. Then at the end of the minute, it prints. So you don't have to wait for that minute to finish. You can see the spike occurring as the seconds tick away and eventually see that you're going to get a nice peak in volume right underneath this candle. Now, here's the exact same thing. I put in 2 arrows here, but you can see price moves laterally. You get the spike, and you get the move up. Now, these are the kind of trades that are extremely low-risk trades, because when you take a trade off support on a real push in volume, it usually means that institutional traders have stepped in, and the trade is usually a nice one. Obviously, you, at the very least, you want it to get to your first target, and you want to get a single out of the trade. But these are the kind of trades that are most likely to give you a double, a triple, or a home run. Now, here's the same volume spike. This one just gives you a single, but it really predicts the break in price up when a lot of traders come in to move the market. It's rarely going to move in a counter trend direction. Once in a blue moon it will. You're not going to get 100%. It's not going to predict the direction in price 100% of the time. But you're very likely to get a movement in price with a spike in the hammer. And that's really what you're looking for. You're looking for movement. When a stock or a future or a Forex market is just moving laterally, when are you going to take the trade? You get the volume spike and you're in. And you've got a very, very low risk, potentially high reward trade. This trade came after there was a big move up. So the second spike didn't really push the market up significantly higher, but it still gave you another winner. Now here's the same thing occurring on a short trade. What you have, now optimally, as far as I'm concerned, and I don't want to give you trading rules, I just want to teach you right now how to use the indicator. Again, price is consolidating. Doesn't have to be consolidating, but oftentimes it is. We want the 15 to have crossed the 50 and both of them to be red, which I think gives you an optimal trade. But you can see you get a spike and sustained high volume period of time. This is 1, 2, 3, 4, 5 minutes of extremely high volume. And that's very likely to take this trade in the direction of the trend. The trend here is down. And remember that a multi-time frame trend is created by big money, and usually a spike in volume is going to push price into the direction of the trend. You can't take it long. You're trading right into resistance. The volume spike gives you the heads up way before it happens here. The spike is here. Now, if you went short anywhere on any of these red candles, there's no way you would get stopped out. So it doesn't really matter where you got in short. Once volume spiked, you're anticipating a nice continuation down, and that's exactly what you get. And this again, this is not a single or a double. This is a triple, because it's coming out of a sustained volume move. This isn't a 1 minute spike. It's a 5 minute spike. Here it is again. You're going to see that with almost every nice launch in price, there's an associated volume spike that you just don't get to see right now, because you don't have an indicator that looks at volume on a minute by minute basis. You can cut this down even to a shorter time period. Or if you're swing trading, you can move it up to a spike every 5 minutes or every 10 minutes. It really all depends upon your time frames, because these are short-term trades. This is set to 1 minute, but it's configurable, and you can take it in any incremental unit of time that you want. Now here's a spike in volume, but there's no trade. You can't trade it long because you're moving into resistance, and you can't trade it short because you're moving into support. You've got the 50 below the candle, and you've got the 15 above the candle, and it doesn't move, even though there was a spike in volume. So that where price is really does make a difference. Then you get a smaller spike in volume, but still a significant spike. If you look at what happens afterwards, where volume flattens, you get a really nice spike up, and it launches the trade to the upside. Whoops. And it launches the trade to the upside. Now, you're not going to get them on every move, but you're going to get them on a large proportion of moves. And when you get it, it really decreases the risk associated with the trade. If you try to take a move up like this on flat volume, it's possible to do, but it's simply associated with greater risk. You're trading, it's a long trade off support on a retracement, and you can certainly take it long, but the fact that volume is flat makes it a much, much riskier trade. And really, our goal as day traders or swing traders is not so much to get winners as to avoid losers. We want to take the lowest risk trades possible. You know, our goal in our live trading room is to make $1,000 a week on a very small number of contracts after commissions. We either trade 2 contracts or 3. It's a very small number. We only need 7 or 8 winning trades a week to make that amount of money. So if you want to make $2,000 a week, you simply increase the number of contracts. Really, the point is that you want to trade with the most precision that you can, only taking the lowest risk entries and avoiding anything associated with significant risk. Here's another trade on a really nice spike, on a 2-minute spike, and up it goes. Here, you got the spike, but it's right into resistance. Now this spike, launch price, but it just wasn't a tradable move. I mean, you didn't know for sure that you were going to get a continuation. You could have taken it, but I consider this to be a much riskier formation. This is how I like to take a trade: on sideways movement into support on a long, or sideways movement into resistance on a short, on a spike in volume and move up. Now, this is the other indicator that I'm talking about. Now, if you're trading, it's sometimes difficult to actually see consolidation. I mean, it's difficult. So we have a pre-formatted consolidation indicator, and it shows you when price is trading in a narrow channel. Now, once it trades 8 candles laterally, this consolidation indicator prints. You see it intra-candle right away when there's the potential. but it will only print and set when you've got sideways movement that's tight for 8 candles. Now you can set it at 6 candles or at 4 candles. You're going to have more sensitivity and less specificity. But I like to look at 8 in a row. And then you take the trade out of consolidation. It's almost always going to break out in the direction of the trend. The first candle that breaks consolidation is right here. And the move down is a real nice one. Now, the reason why trades out of consolidation are so powerful, and the longer the market is in consolidation, the better, is because within this channel, what you capture are tons of sellers in one direction and tons of buyers in the other direction. So you have a lot of buyers and a lot of sellers holding onto their shares or lots or contracts, hoping that the market is going to move in the direction they predict. We know with a really high degree of likelihood which way the market is going to break, because we know what the trend is. And these are counter trend traders, something that we really never want to do, because they almost always get stopped out. They almost always lose. And what pushes this trade down are two forces. One is that in all likelihood, the institutional money is going to trade in the direction of the trend. And two, you're going to stop out all the buyers that are holding long positions in this consolidative pattern. And sometimes the trades just explode out of consolidation. And they're difficult to catch. They move out so fast. So you really have to be on your toes to capture these moves. But they're very low risk trades again. And that's what we're looking for. We're looking for low risk trading opportunities that are very likely to give us a winner and very unlikely to hand us a loser. Here's another pattern. Now, when there's a multi-time frame alignment in trend, this consolidation indicator looks at multiple time frames depending upon the time frame of your trading chart. When you get an alignment, you get a special signal. That's this triangle. It's small, but it's there, and I didn't put it there. It's created by the software. And the software is actually telling you that consolidation aligned on multiple time frames is predicting a break on this candle. And when you get that signal, you can actually take the trade inside the consolidative pattern, because it's very likely to break, because it's a multi-time frame analysis. Now, you're not always going to get the signal, and you don't need it to take a trade. But if you want to even drop your risk lower, you can wait for the signal to appear, and you're going to get in a candle early. If the signal didn't appear, here's your break on this candle, and your move up. In any event, no matter how you slice it, it boils down to a very, very low risk trade. And depending upon your risk tolerance, you could take this long trade all the way up, right off to the edge, right off the right edge of the chart. It's a very powerful launch of price to the upside. And if you can tolerate a little bit of a pullback or consolidative pattern again, you can wind up getting very, very big moves. Now, I didn't configure the indicator right, so instead of giving you a triangle, this one gave you a dot. So this should be a down triangle. Now, it triggered you into the trade early because you still got another down candle, another up candle, and another down candle. But there's no way you should have been stopped out of this trade. And if you got into this trade right here, you still should have gotten this really nice move to the downside. This is really unusual for the signal to come in early. And the reason I put this slide in is to show that every now and then it will come in early. But even if it does, if you set an appropriate stop, there's no way it's going to take you out of the trade. You're in it for the move down. Here's another, there's no signal here. Now I changed from range. This is tick. I believe these are tick charts. And they may be time charts. I don't even know. I should have labeled the chart, but it's irrelevant because it works on any time, tick, range, Renko, Unirenko. It's going to create the consolidative pattern. As soon as it hits support, you look for the break. The break is right here on this candle. Launches you up for a really nice move. Very low risk trade. Here's another move. There's the consolidative pattern. You're catching buyers and sellers inside the channel, and they're all sweating it out. We're not sweating it out because we believe, based on the numbers, that 80 to 90% of the time, consolidation will break out into the direction of a defined trend. There are going to be some consolidative patterns that occur where there is no defined trend, and you get no trades. But when you have a defined trend here, the 15 is up, the 50 is yellow, but swinging. You've got a nice, there's your break, there's your move up in consolidation, there's your next move up. Now, you have to have a lot of risk tolerance to take this pull back to support, but if you're willing to take the risk, you got the whole move up. It really launches the trade on a big move to the upside. If you have a very tight stop, you're still going to get a nice move up. The key is it's almost never going to move in the counter trend direction out of consolidation. Another pattern, almost exactly the same. They almost look identical, but they're not. Now here are two areas of consolidation. These are all created by the software. You get 8 candles, it prints, you wait to hit support, you get a break. Now on the break, you go back into consolidation, but that doesn't matter to us because you're not going to get stopped out because your stop is somewhere below your entry candle, and you just take your next launch up and you get really a very, very nice move. I don't remember what the tick size was or the time size, but these were big candles and long time frames. And this is a very, very big move. The reason I took the size of the candle out is because I wanted to emphasize that it's irrelevant. It doesn't matter whether you're trading a 1 hour candle, a 2 hour, a 4 hour, daily. It doesn't matter. These could be daily bars. These could be minute bars. These could be 377 tick bars. Price consolidates in any market on any kind of candle. It's going to move laterally almost always till it hits support on a long and then launch up in the direction of the trend. Here you got 3 signals. Boom, boom, boom. Now, it didn't matter which one you took, because I also wanted to show you that sometimes that multi-time frame alignment is going to keep hitting you with entry signals. Now, if you took the first one, no harm. You're always, you remain in consolidation and you break to the upside. And again, and this happens I see commonly, you get the retracement, but then the huge move up. But the move itself is simply more than enough to give you a single or a double on this trade. It's a very nice trade, and you're going to make nice money on it. And the key is very low risk. And that's what we look for as swing traders and day traders. Entries associated with real low risk. Now we're going to combine the two, the consolidation pattern and the volume hammer, or the spike in volume. Now remember, when the candle breaks consolidation, you're going to start, you don't start, essentially the break in consolidation signals when almost all these long traders are going to get stopped out. And you can see there's a huge spike in volume. Now it comes here on the candle break of consolidation to confirm. You got it here, but consolidation didn't break. Just continued to move. On the candle that did break, and that's what you wait for, the break in consolidation, without the signal, you got to take the break. You got another spike even higher because you've created a big volume push because you're now stopping out all the long traders. Now this is a counter trend trade. And if you want a counter trend trade, I've looked at a million counter trend formations. This is the only one that's halfway reliable. And I still wouldn't recommend that you counter trend trade, because I think your lowest risk trades always come with the trend. It just so happens this happened to break in a counter trend direction associated with a volume spike, which really helps guarantee. I don't want to say it guarantees, because that makes the assumption that it's 100%, but it becomes a very, very low risk trading opportunity. Here it is again. The consolidative pattern, the break in consolidation on a volume spike, and a beautiful move down. Now, although the indicator did not show it, because this was not tight enough or long enough to create a consolidation pattern, you can see it's moving sideways. And you can see the volume spike. It's a smaller one, but it's still a spike. Takes the trade one step lower. Now, what you should have been is in this trade all the way down. There's no reason that you'd have bailed on this trade. And this single volume spike out of consolidation should have taken you all the way to the bottom of this trade. Now, you're never going to be able to pick a bottom or pick a top exactly, but you should hopefully get the majority of this move down. There's the spike and the signal out of consolidation and this move to the upside. Really, really nice move. Again, right off the right edge of the chart. And I formatted the indicator incorrectly to give us a circle instead of a triangle. Yours will be formatted with a triangle if you like the indicator. And it's going to give you the entry. When you get these, you're in a candle early. You don't wait for the break. And when it comes with a volume spike, you're in. And you get a nice move. Then consolidation, then another leg up. This is the way price moves. It's universal. When the markets go, and I talked about this, I have a master class, a mentorship, about how the markets move in cycles of low volatility to high volatility. And if we go back, low volatility, high volatility, low volatility, high volatility. It always cycles like that. It goes back and forth and back and forth. That's just the natural harmonic, the way the market moves. At some point, the power of the bulls and the power of the bears equals out. And it's just the universal way that markets move. The thing that you don't want to do is trade into consolidation. So you're going to get stuck in it. What you want to do is wait till consolidation forms and trade out of it, because that's where you get your push. That's why you just don't jump into a trade. Here's another. Here's the dot, which should be a triangle, with a huge volume spike. And up it goes, and off the right edge. That's a really, really nice move. And again, very, very low risk. And the likelihood of high reward here is very high. You're trading close to the 50. 50 is mean price. And when you're trading close to mean price here, it's likely you can get yourself a really long move. But nothing can predict the length of the move unless you hit some upside resistance. All you want to know is is basically to be guaranteed that whatever your target is, it's going to take it out. And you lock in profit on the trade. And then if you can get it to run, it's just icing on the cake, because you're already in the green on the trade. And that's our goal on every trade, is to lock in profit and then let whatever's remaining, whether it's one contract or one lot or 1/3 of our shares of a stock, see if we can get that to move even further. Try to take a single or a double on the first and try to get your home run on the second. That's the way I do my trade management. I'm not giving trade management advice here. It's all up to you. All we care about is that we get a move that's a predictable move out of consolidation on a spike in volume that will launch this trade in the direction we want it to go. And here's a great trade down. I showed this to you before. What I did was, now it's got the volume hammer in it. Remember the down triangle came in a little bit too early? Well, here's where you could have avoided taking it, because it came with no volume spike. And you see how it makes this more specific? Take the breaks of consolidation with the spike, and you're going to very likely get a move down. But if you were in this trade on this signal, there was no harm. There was no stop out, and you still got a winner. Now, I think, no, this is a different slide. Here's the spike. This is 1 minute, and you're going to see this line go up like this. And in the course of 1 minute, that's a projectile move. And it comes right underneath this candle in real time. And you're going to know, since this is the break of consolidation that you're in. And you get a nice move up, and you're going to lock in money. You can exit the trade and take it again on a pullback to support, or if you're willing to take more of a risk, let the trade retrace and take it all the way up. But this just locks in profit for you immediately. That's all that's important. Okay, here's your move down. It's a terrific move. Just like this. This little doji may not break consolidation. I'm not really sure. And this one comes back against you a bit. If you have a really tight stop, it might take you out. But you can see, if your stop is set appropriately, you're going to get the nice move down. It almost always predicts the movement down. And here's just your stellar trade. And remember, the sideways motion does nothing to take you out. You're still back in for the second leg down. And that's a great consolidative pattern. And you'll see there's actually two channels in here. You have two blue lines, one red line. So the lower channel is really formed twice. And the more channels, more confluent channels that occur, the more power there's going to be to the launch down. And this is going to be hard to see if you're trading 2 or 3 instruments, 2 or 3 markets, and you don't just stare at one. This indicator just points it right out to you. And if you want, you can get an audible alert on a triangle, on a system-generated signal to take the trade out of consolidation. And there's your launch. Kaboom. Remember, the triangle now comes with the spike, and up you go. And that is really a beautiful trade. Incredibly low risk and potential major high reward. You should get this whole move all the way to the top. And these are big candles. We're back to range. I believe these are 13 range candles. And if you're trading futures, this is 13, 26, 39, 50 some odd ticks right here on this move. And then more, then more, then more. I mean, this is a 100-tick move, at least. So let me give you the offer that we're making, and then I'll go over and see if there are any questions. Now remember, it works on any time frame, any market. Now, it is only formatted on NinjaTrader 7 and NinjaTrader 8, but if you have a lot of other platforms, your data feed can run a demo of NinjaTrader 7 and NinjaTrader 8, and for free, you can format it on a NinjaTrader demo and take the signals on your live platform. I know thinkorswim is one that you can do that with, which is great. There's a whole bunch of others. If you're interested, we can tell you if your live platform, if it's not NinjaTrader 7 or NinjaTrader 8, will power the demo. And if it does, you don't need to buy a data feed, and the demo of NinjaTrader lasts forever. And when you see a signal on Ninja, you just take it on your live platform. Now, normally, the consolidation's $2.99 and the hammer is $1.99, and we're discounting them both to $99. And you can get them individually, or if you want to get them together, they're $179. And we'll format them on your computer. Sergio does all the formatting. He'll make sure they work perfectly. And we're going to format them in what I believe to be the best pattern, which is 8 candles laterally, and a narrow channel, which we've optimized. And you should use our settings. Now you get a lifetime license, and if we make the indicator better, you get free updates. And because we want to really make this a great offer for because Traders Corner was kind enough to invite me to present, I'm also going to give you access to the live trading room, which is $199 a month, and that's all for $179. Both indicators and the trading room, and the offer expires on Sunday at midnight. So let me go quickly to the platform and see if there are any questions. Hold on a second, I've got to find them. Here it is. Okay, I don't think I have them here. Hold on one second. Excuse me, I'm hunting. Okay, I don't see any questions, and I'm not sure if I'm looking at the right box. Just hang on one second. Rory, it's in the chat, right? I don't see any questions. Excuse me 1 second. I don't have the question box, and the moderator is moving it over. Okay, now I got it. I got it. Hang on 1 sec. Okay. All right. Here we go. Let me open it. Okay. Okay. All right. Giuliano. You can calculate this with Excel to pick up the volumes between two time frames and to calculate the rate per unit time. I'm not sure if you can do that with Excel. I really don't. This is just hard coded into the indicator. And you'll see Giuliano, I'm sorry if I'm mispronouncing your name, I apologize. When you go into the settings, it's going to ask you what incremental unit time that you want to use. You can use minutes, you can use hours, you can use any increment that you like. Hey, Philip, this is being recorded. Kennedy, yes, it's a 15 and 50 SMA. It'll work on an EMA too, but the chart that I used was an SMA. R. Sykes, let me see if the moderator can put a link in the room. Hang on 1 second. The link should be in the chat box to sign up. If you don't see it, we'll be sending you an email shortly with the payment links on it. But if you look down into the chat box, you should see a link. So listen, everyone, thank you so much for giving me your time. I really appreciate it. I'm telling you, this is really going to help you with your trading. I use it in the live trading room every single morning. And you're going to join me there for a month if you come aboard. So listen, everyone, have a really, really wonderful afternoon. I think I'm right on time here, I believe. And I really wish you the best of luck. Take care and have a really, really wonderful day. Bye-bye, everyone.